You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome back to the show, everyone. Today, of course, is the day when we speak with Zulfi Ali about what's going on in the market. Zulfi, how are you?
I'm doing well, Buck. How are you doing?
Good. As a reminder, Zulfi is with Volatility Wealth. That's Velerity Wealth. And Volatility is also a broker-dealer that works with us. And if you haven't done so, make sure to join the accredited investor group because there's some significant activity in there right now. And if you are an accredited investor, you should get onboarded sooner rather than later because some of these massive discounts, they're not going to last for long. This is going to be sort of a fairly short period. I anticipate we've got about 6 months or so, maybe a year to sort of load up on, heavy discounts while these rates are kind of descending and the liquidity comes back in the market. But that is a warning to you. Sign up for Investor Club at wealthformula.com if you are interested in participating in this market. All right, Zulfi, let's talk a little bit about this week's podcast. The podcast on, I talked a little bit about Bitcoin, but mostly it was about central bank digital currencies.
Yeah, well, I mean, for me, it was a good education session. I'm not, deeply focused on CBDCs. Did I get that right?
Yeah. I accidentally said CBD, but then that was another industry entirely
new and upcoming industry. But yeah, I mean, listen, it really seems like it's inevitable, right?
Yeah.
The technology's there. It seems like the government would have incentives here, right? Because if they could have a currency that they can better control and have more visibility into the flows versus cash, why not? Ultimately, as I think you guys mentioned, consumers have already gravitated towards, the efficiency of digital currency, if in effect, through credit cards and apps and that sort of thing. So it wouldn't be a huge leap here for individuals, like yourself and myself to adopt a digital currency. So, I don't see why this wouldn't happen, and why it wouldn't be seamless. I guess there's some things to be worked out in terms of policies and, regulation, that sort of thing. But I'm betting that within 5 to 10 years, this is going to be reality.
Yeah, I guess again the big problem. I mean, the biggest concern is privacy, right? So now there is this theoretical ability for you to spend cash without people knowing, where you spent it, and have transactions between friends that don't need to be documented, and have the IRS on your case because you gave your kid money or something like that and demand the taxes, or, to deal with estate issues and things like that. Those kinds of issues relate fundamentally to personal freedoms that I think that might become a real problem. And it's hard for me to see that this becomes anything. Maybe it becomes an alternative to cash, but I just don't see it replacing cash. I think maybe long term you could see it sort of phasing out cash in the decades to come potentially, but short term I cannot imagine that this would get through any sort of legislative process.
Yeah, well, let's keep an eye on it. I think there's going to be some stuff coming up, and I thought another interesting component of your discussion was what role the banks would play in the context of a digital currency. So obviously today we need them to hold our cash. We also need them to lend out to borrowers, right? Whether it's corporate borrowers or individuals. Lending these days has been increasingly coming from non-banks too. So we're seeing, very large institutions, whether it's, the likes of KKR, Apollo, whatever, they're into corporate lending. You've got insurance companies and other mortgage lenders that are not banks that are directly taking market share. So, that part of the market is already getting quite competitive for banks. And if we don't need banks to hold a bunch of cash for us, you really wonder, what's the role?
The banks will carve out a space for themselves, right? When I think about what the implications of this would be, it would be that, okay, so now you've got this digital cash that you can store basically, and your bank is essentially, the idea would be the government instead of holding your money at the bank, which in many ways would be more secure because now you're not dealing with FDIC rules, stuff like that. Your money would be backed by the government. But if you're going to include the banks in there again as some third party that has to administer this and stuff like that, it's hard to imagine that on its face that'll change a whole lot. I mean, I'm sure the banks will get their piece one way or another.
Yeah.
What I think is an interesting concept, though, is the government directly holding money. And the positive side of that, as you kind of, I think, alluded to, was, well, would this mean that you could take loans directly against the U.S. government? I mean, obviously banks do that all the time, right? I mean, they get low interest rates and they turn around and they lend that money out to us. Well, could this mean that to a certain degree you could do that with the government? That sounds potentially really interesting if it's low interest, right?
Sure.
But I mean, well, I guess we'll see how that all comes out, but it's thought-provoking, certainly.
It is. It's certainly interesting stuff. And then on the Bitcoin part, where I think you did the overlay.
Yeah.
I mean, I agree with you. The market cap is a main driver, I think, of the volatility of Bitcoin. So, you mentioned that it's still pretty small compared to other asset classes. So I kind of pulled some of the other asset classes. Bitcoin, just over $1 trillion, depending on which day you're looking at it, because it moves up and down so much. But just over $1 trillion. If you look at gold, it's somewhere between 17 to 18 trillion globally. U.S. Treasuries, 27 trillion. The market cap of the U.S. stocks, 55 trillion. So you're talking, orders of magnitude higher from where Bitcoin is. So, I think that will hopefully, keeps going the right way as you get more institutional ownership. You get more traditional ways of owning it through ETFs, for example, right? All of a sudden, you've got the investment management, asset management community able to, allocate it across their clients' portfolios. You've got, longer-term holders rather than just, a big chunk that are trading this stuff to make money on short term. I think all of that is a maturing asset class.
Yeah, and it's already out of the box, right? It's Wall Street has already figured out this is something you can make a lot of money with. BlackRock's not a bunch of dummies. These guys know this is going to make them a ton of money, and that's why they have an ETF. Sure. And I guess my point in bringing this up was that one of the main reasons cited by investors who are against Bitcoin is its volatility. It's like it can't be a storage of value because it's too volatile. Well, I would argue that it's probably not digital gold yet. I think that's the long-term goal here. However, I have no doubt, as I've mentioned, that money will continue to stream into Bitcoin over time, vis-a-vis ETFs, vis-a-vis a new this newer generation ultimately that views Bitcoin as safer than stocks. Mm-hmm. And as that grows and that market cap starts to get to a point where it does get close to gold and all that, well, then this is not a particularly volatile commodity anymore. And it's probably not something you're going to make huge profits with anymore. So my thought on this is if you're going to get in while it is volatile and you have these huge dips and you can take advantage of, and then just ride it for years and years and years. I mean, I have hopefully I'll never have to sell this Bitcoin, but I'd like to hold it until it declares itself. And then at some point when it is a digital gold and it's moving like gold moves rather than cryptocurrency, then you can just get out of it,
Yeah. I think, the piece that is a nuance that I think would also be important is correlation. So the great thing about gold, it's not correlated to the equity market. So you can buy gold and it's not necessarily going to move in the same direction as your equities portfolio or even your fixed income portfolio. And I think Bitcoin has the potential to do that because there's no inherent reason why it should be correlated, but it just happens to be pretty correlated today because it does go up and down in relation to how much money is swinging around in the markets, right?
Yeah,
Swishing around in the
it's
markets.
new, it's
Yeah.
digital, and I think like the investor class, the older investor class, does not view it as a commodity yet. I think they view it
Yeah.
as a tech play, and I think that over time, as that market cap grows and there's new sentiment amongst younger investors coming up, I think it changes. That's what I think is going to happen, but who knows? You never know.
Well, we're less than 2 decades into Bitcoin.
Yeah.
Gold's been around for 4,000 years
Yeah.
as a form of traded money. So
Yeah.
we,
Yeah.
we give it a little more time.
We'll
Let's
give it
see
a
what
little bit
happens.
more time, at least.
Yeah.
At least another year or two. Yeah. What else we want to talk about? Let's talk about the markets. What's going on?
Yeah. Well, we are a day away. Today we're recording on Tuesday, but Wednesday, tomorrow, is going to be the day where the FOMC meeting concludes, and hopefully Fed chairman will be out cutting rates. So that is the big item that we're waiting for. In general, the economy is doing well. It's perfect because it's softening, but it's not crashing. Inflation is in check. The job markets are cooling, but they're not cratering. We just had actually retail sales released today. Shows that the consumer spending remains healthy. It actually came in just a little higher than it was it was expected, which is okay. Nothing dramatic. And so it's all poised to point in the direction that the Fed actually has a chance to nail a soft landing. It's something that the Fed has very little track record in doing. Typically, these all end up in recessions before we come back out. But it really looks promising this time, in the sense that the Fed seems to be ahead of the curve, and with a Fed rates cut starting tomorrow, we could be in a good position because the Fed does have a lot of ammunition still.
All right. So where are the bets here? What are the bets? 25, 50, 25 basis points versus 50 basis points. So what does Wall Street think?
The latest and greatest thoughts as of this morning is that 2/3 of the market participants in the stock markets and fixed income markets, all that, they believe that it's going to be a 50 basis points cut.
Really?
So more than half, definitely more than half.
What do you think? What do you think?
I think.
I think 25. I think 25.
I think they should go 50.
Yeah.
But I think because the FOMC, the way the FOMC board works, it's got to be unanimous pretty much. And so even if Chairman Powell was trying to push these guys into 50, there are some inflation hawks on the reserve board. So my guess is he steps out with the 25 basis points move, and then the language is likely to be very much saying that they're going to expect to cut more and all that kind of stuff.
Well, so let's back up just real quick on this CPI. Last week, right? Wasn't it CPI?
Yeah, we talked about CPI last week. That's right.
And what?
That's right.
Let's review that. What was that? What was CPI?
I think it came in at 2.5, I believe, and the previous month was like 2.7. I could be off by 0.10 or whatever. Yeah, somewhere in those.
So it's down. So inflation continues to go down. So it's So they have all the reason in the world to think that, okay, well, we need to do something, and then it's just how much are we going to do?
Yeah, and what's driving the potential for a bigger cut is the job market cooling down too fast? And we talked about this last week, I believe, as well. We had 4 consecutive months of declines in employment. And so the unemployment rate had kept going up. Last month, though, for the month of August, it actually kind of stabilized. And so I think if the August job reports came out and that was another decline in the number of jobs, new jobs, I think the Fed might be a little closer to that 50% cut, which they might do anyway. But anyway, so. They've got some mixed data that they're dealing with, and it's really just it's really a balancing act for them. Do they say, okay, do we err on the side of making sure inflation does not come back, or do we err on the side of making sure that employment does not totally unwind here?
And on that bet, I bet you they err on the side of inflation, though, because I think that's what they're really scared of. And even if they end up with a little bit of a recession, I don't think they would consider that a loss.
Yeah, I think that's a really fair point, because again, the markets are doing great, right? The Dow Jones Industrial Average trading at all-time highs. S&P is very, very close to its all-time high. It might have hit it today. I wasn't watching it all day. Equal weight S&P index is trading at all-time highs, which means that it's a broad rally. So even without the mega tech stocks, the broader stock market is doing just great. NASDAQ is actually down about 5% from its all-time highs in July, but that's getting hit by those mega cap tech stocks that are down a bit. So there is probably comfort from the Fed that, okay, there's lots of money, economy's doing well, the markets are happy. Let's just take it down 25 basis points, and we can always cut more if we need to, right? So I think that could be a thought process that they use. But like I said, the equity market's definitely kind of baking in a 50 points basis cut. Bond markets also, I think, are baking at a 50 basis points cut. The 10-year Treasury, is down at 3.64%. Remember that was as high as 4.5% 3 months ago. So
what was that? What has that trend been the last few weeks? Do you know?
It's been kind of choppy, but holding at about that level in the last, I'd say, 2 to 3 weeks. And then it was higher for the months preceding that. I mean, that's the lowest it's been really since we had the scare back in 2023 with the bank default, Silicon Valley Bank. Defaulting and stuff, and then the rates had gone down. The market's freaking out that there could be a more damage to come because of that. But then they quickly went back up. So that is a pretty decently low yield for the 10-year.
And then you've got 10-year. So the thing that in multifamily we talk a lot about is SOFR, and SOFR is linked with the Fed rate. So why don't you talk about that?
Well, yeah, I mean, as the Fed brings down rates, you're going to have a direct decrease in SOFR. So SOFR is trading right around 5.25% today, and that's exactly where the Fed funds rate is. And for every basis points decrease in the Fed funds rate, you're pretty much going to assume the same decrease in SOFR. So, if you now take a step back and say, okay, it is assumed that the Fed will cut 125 basis points by the end of the year. That's what the general consensus is in the Fed funds rate. So, coming down from 5.25 down to 4, down to 3, right? So you're down to 5, down to 4 for this year, and then 2025, the market assumes that there's going to be another 100 to 125 basis points of cut. So down to 3 by the end of 2020.
So 125 this year, 125 next year. That's
what the market is assuming.
So
correct.
Yeah, and I'm going to just take a moment here just to emphasize what we've been talking about, because again, I have been talking about this period in time for real estate acquisitions as sort of this Goldilocks period. And the reason I've been doing that is because when we buy these assets, it's the loans are based on SOFR, and they're not, so we know that SOFR is going to go down, but it's not going down like the 10-year Treasury in real time. So if we can buy something at cash flows now at higher rates, and then we go into a descending rate environment, what happens over the course of the next year or two is that as interest rates go down, asset prices go up. So again, that's why I keep calling this sort of a Goldilocks period, where you literally know, at least you're forecasted to have rates going down. Those rates have not gone down yet. And if you look through historical periods of time when rates have gone down, those are some of the periods where real estate investors make some of the most money. And I just want to remind people of that because I do think people like to get involved with this kind of stuff when there's froth in the market. That's not the time to do it. It's to do it right now and wait until there's froth in the market and get out. So.
Yep. And, we'll touch back on some of that thought process later on in our discussion today. I want to talk about kind of economic cycles, but
Right.
But going back to different asset classes, gold, pretty much trading at all times highs again. 2,590 per ounce. I think it actually hit 2,600 today. So continuing to rally, and Bitcoin really strong today, up 5 to 6% at one point, trading I think at 61,000. It seems like a lot of the cryptocurrencies were trading up today as well. Again, I have no real answer as to why, but that's the case.
With cryptocurrencies, it's like these movements are sort of meaningless unless they're 20, 30, 40% at a time. So, I mean, that's, again, Bitcoin's at 60,000, whatever, but if it's down to 55,000 in next week, it's almost meaningless. It's like, again, because these market caps are so small, you just have one whale dropping out selling a bunch of Bitcoin, and, so use it as a buying opportunity.
Absolutely. So I think for the next section, Buck, what I wanted to talk about was just kind of, going through the concept of an economic cycle. Because I think a lot of times people get stuck in the concept that, the economy's just bad or the economy's great. And they're not taking a step back and say, okay, because the economy is a living, breathing thing, right? And it typically moves through cycles. You go from an expansion to peak, from peak to where when you start to contract in the economy, and a contraction eventually leads to a trough, and then you go back to expansion again. And the rate cutting or rate increasing cycle by the Fed kind of follows that to help kind of smooth out those types of cycle peaks and troughs. So we're pretty clearly post-peak. We are no longer in the peak period. We know that because GDP has slowed. We know that because the labor markets are cooling. We know that because inflation is coming down. So we're definitely in contraction. And so, what is the Fed trying to do? Well, they're trying to now adjust the Fed rate so that our contraction does not lead to a really tough recession. And the recession, being the trough part of the cycle. And so, they want instead to have a softer landing where, employment doesn't get destroyed, jobs, don't go away. We don't have a lot of pain and that sort of thing in the economy. So,
hey, when was the last time we had a recession? Technically, just COVID, right? I mean, I guess.
COVID was a.
But before that, how about like one that wasn't caused by a global pandemic? It's been some time, and we're going back to 2009 at that point.
Yeah, I'd have to go back and check the data, but we had before COVID, we had one of the longest periods of time between recessions. And it could be as far as.
Yeah, I don't think we had one since 2009, 2000.
But we did have obviously a very scrunched recession in COVID, and then just a really funky economy because of all the cash that flooded in and that sort of stuff. But I think things seem like they're starting to normalize now. And so, things are moving in a somewhat predictable manner. And like I said, right now we have a lot of reason to be optimistic about the next phase of economic growth. I actually think you could define this period right now is that we have the Fed has a put that we can all kind of bank on, in the sense that given that we're at 5.25% for their Fed rates, if the economy starts cooling faster than we want it to, faster than the Fed wants it to,
they got a lot of gunpowder.
They got a lot of gunpowder, and remember, they haven't even done anything on the quantitative side. So they could launch a quantitative easing stance.
Weren't they tightening though?
They are still in a tightening mode. And so they're still taking cash out of the system, not as aggressively as they were a year ago, but the Fed is still tightening. And so they could flip the switch on that, and in a sense that if they wanted to go to quantitative easing, all of a sudden, the Fed's buying mortgages, they're buying different assets, all that kind of stuff, and all that liquidity comes right back into the market. So my feeling here is that you can be optimistic in the sense that we're going to have a slowdown. The Fed has a lot of levers to pull to make sure that it doesn't turn into a recession or something nasty. Right? It might be a mild recession. It might be a soft landing where we have no recession, and we're going to accelerate back into growth. And so I think that is a really great situation to be in right now. We're going to see borrowing costs decrease. We're going to see the economy stabilize and then come back to growth. You're going to see spending, from corporates start to tick up as they gain access to lower cost capital. Labor markets will again tighten up a bit. And at some point, we're going to be in the expansion leading to a peak again, maybe another 3 to 5 years from now, where the Fed has to start thinking, okay, there's inflation peaking through, and we've got to start tightening again from a Fed policy perspective. But again, I think what I wanted to hit was, when we're investing, right? As an investor, you want to think about where we are in the cycle, right? That's really important. Not just kind of throw in your investment into any asset class just because, for whatever reason. But it's important to think of the cycle ahead of us when you're looking at it. And so, in all the different things that we just described, there are asset classes that tend to work better. You touched on real estate. I 100% agree. It's just this perfect situation. You've got an asset that is financed by debt. Debt costs are going to decrease. You're going to eventually have the asset increasing not just from lower debt costs, but then when we get into a growth environment, the asset's going to continue to increase. From that perspective. So your exit timing will be pretty good if you start buying today at the end of the day. So that is a good asset class. I think on the equity side, I'd probably favor larger blue chip dividend paying stocks because their cash dividend yield is going to look attractive versus a much lower interest rate environment on fixed income.
What kind of dividends are those usually, like in those large cap?
Yeah, they can range. I mean, utilities can range anywhere from 4, 5, 6%. When these stocks are trading down, the dividend yield goes up, and all of a sudden they can be paying out like 7, 8% annual cash dividends. So you should keep an eye on those, and those can be attractive as investments from a longer term perspective as well. We touched on gold. Generally, I think commodities such as gold and silvers start to do well just because they anticipate that in the future there's going to be inflation. Because if the Fed starts to lower rates, eventually we're going to get a growing economy, and eventually inflation is going to come back. And so, you want to be in assets that can protect you if inflation starts coming back quicker than expected. And things like infrastructure and transportation, again, they all benefit from lower interest rates and an improving economic growth trajectory. So that's what I kind of want to make sure that investors are taking away from this conversation in terms of how they look at their investments.
Well, that sounds good. So I guess we'll see what happens with the Fed, and otherwise, do you have anything else for us this week?
That's it. All eyes on the Fed. That's it.
Yep. Okay. Well, thanks for coming on. Again, Zulfi is with Valerity Group and Valerity Wealth. Go check out valeritywealth.com. Basically what they are is a family office for people who don't have ultra high net worth. So if you're somebody who makes a good living because you are a high paid professional, maybe you're a physician or maybe you're a dentist or a lawyer or whatever, and you want to get some of the same types of benefits with a family office type perspective, reach out to Zulfi at valeritywealth.com. Thanks again, Zulfi, and we'll see you next week.
Thank you, Buck.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.